It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by PortfolioCrafter.com.
Welcome to this edition of the TradingTips.com video newsletter. In this episode, we'll be looking at how you can add income to your diversified portfolio by investing in dividend stocks. Without further ado, let's begin. First, a few basics. A dividend is a distribution of a company's earnings directly to shareholders. Dividends are normally declared annually, but paid quarterly. They are decided on by the company's board of directors. Dividends may take the form of cash, stock, or property, but they're usually cash payments. Some companies allow you to reinvest your cash dividend payment in stock. Finally, dividends may be awarded to one or more classes of shareholders, such as the holders of preferred stock. In this episode, we'll be looking at dividends issued to the holders of common stock. Now a few quick statistics. You'll find these on any website publishing stock information. First, you have the dividend, usually expressed in an annual amount of dollars and cents. Again, most companies pay their annual dividends in quarterly installments. The next important statistic is dividend yield. This is the annual dividend amount divided by the current share price of the stock and expressed as a percentage. The dividend yield goes up when the stock price goes down and vice versa. Next, we have payout ratio. This is the percentage of the company's earnings that it distributes to shareholders. Finally, we have dividend growth rate. This measures the growth of a stock's dividend over a specific period of time, normally 3 or 5 years. Dividends are technically paid on the dividend date or the payment date. Again, this normally happens 4 times a year. But another important date to look for is the ex-dividend date. If you own a stock on its ex-dividend date, then you are entitled to its dividend, and the ex-dividend date comes before the dividend payment date. After the ex-dividend date, a stock is trading ex-dividend, which means that the dividend belongs to the seller, not the buyer. Beware of this when buying dividend stocks. Also, it should be noted that if you sell a dividend stock short, you are responsible for paying the dividend on the shares you have borrowed. However, all of this is not as big of a deal as you might think, as the stock's price typically goes down by roughly the dividend amount once it is trading ex-dividend. Dividends are normally paid by more mature stocks rather than growth stocks. That's because growth stocks can better use their earnings to grow the company, whereas mature stocks have nothing better to do than redistribute their earnings to shareholders. One such mature stock is AT&T. It currently has a dividend yield of 5.9%. Here is AT&T's 5-year chart. Wherever there are gray dots, AT&T issued a dividend. In the 5-year chart, we see that AT&T had a starting price of $36.90 and an ending price of $30.12. After 5 years, your capital appreciation would be negative 18.4%. That's not good. But over the course of 5 years, AT&T paid $8.50 in dividends to shareholders, making the total return $38.62. This gives the stock a total return on investment of plus 4.7%, which isn't very good for a 5-year return, but certainly a whole lot better than negative 18.4%. A stock typically raises its dividend when it's in good financial health. An exception may be when a stock first begins paying a dividend or when it dramatically raises its dividend. In either case, this could mean the stock is no longer oriented on growth, or that it is making a bold move to try to encourage investors. In either case, these could be bad signs. On the other hand, when a stock lowers or worse yet suspends its dividend, that is a very bad sign. For this reason, stocks that pay dividends normally do whatever they can to keep paying the same dividend or raise it slightly over time. How about when a stock has a payout ratio of greater than 100%? Well, this means that the company has no ability to fuel future growth and is actually distributing cash from its balance sheet, not just that it generates from operations. This is a low growth or no growth stock, but an income investment may be just what you're looking for. Stocks of this nature do tend to lose market value though, so keep that in mind. Finally, let's consider stocks versus bonds. In many cases, good stocks like AT&T have higher yields than many bonds. In the case of AT&T, you have a greater chance of capital appreciation along with the 5.9% dividend yield. Finally, here's an interesting chart comparing the total returns of dividend stocks and non-dividend stocks from 1972 to 2007. Dividend growers and initiators were the best overall performers. Non-dividend paying stocks were the worst. We hope you've enjoyed this TradingTips.com video newsletter. Thanks for watching and good trading.
This video newsletter has been brought to you by Portfolio Crafter. Manny Backus designed Portfolio Crafter to be one of the easiest trading systems available on the web today. But don't take our word for it. Visit www.portfoliocrafter.com and access the free special report. It will show you how you can place profit-rich stock trades in just 15 minutes a week. Read the free report, and you'll understand how the easy money's made in the markets. To access the free report, visit portfoliocrafter.com. Portfolio Crafter, another market-beating investment service from Wealthpire. Take control of your financial destiny. View more Trading Tips videos. Visit tradingtips.com. Sign up for our free video newsletters and become a successful trader today.